So here's my example. And this is a real example that was used that I actually was managing a portfolio in NVIDIA. And it's just really straightforward. It's not the exact same criteria that we're going to be using. We're going to have a little bit more, well, just a little bit more rules behind what we're planning to do with the stock outperformer. But here's the initial purchases. Going all the way back to 2023. Now, this is prior to the split in NVIDIA. On the 18th of October, which was a volatile month, decided to buy one option contract, a deep in the money option contract. NVIDIA was trading at 424, and we bought one January 17th, 2025 option contract at that point in time. And that was 457 days to expiration. We're probably not going to go out as far with some of the option contracts that we'll be trading, and part of the reason why is that we're going to be managing the position a little bit more. Okay, so here's where the time value was in that option contract, and we do want to make note of that. We're going out way far in time, but we want to know how much time premium we're paying, especially if we're going to try to sell some calls against that position as we go. Delta was 78, market value was $15,500 to buy that one option contract. Let that ride, got through the October time period, one of the more volatile time periods in the month, and then we came back and bought two more NVIDIA, the same strike calls. At this point in time, there's 403 days remaining. The time value now is $36 in that option contract. Here's the delta, and here's the market value. So bottom line is this was 25% of the $200,000 portfolio. There were other positions that were in. It was a time period where the market was strong to the upside, so almost a lot of the positions did well, but NVIDIA obviously stood out because we're heading right into that stock split. So all that said, market's going up. Here's what we did. Next, NVIDIA is about to announce earnings. It's February 21st now, 2024. NVIDIA now has jumped to $681.45. The decision on my end was to sell one call option. It was becoming a big part of the portfolio, and we had the nervousness that was going into the earnings. So we ended up selling one of the 380 calls, and then we're going to keep the other two riding into the earnings. So 331 days, we actually just brought in capital to try to make it so it wasn't such a big part of the portfolio and capitalize on some of the gains. Okay, NVIDIA announces earnings, the stock does well. Now this is where the stock outperformer, where we're going to be using this strategy a little, or this concept a little bit more as we go forward. So what did we do with this position? And notice, I should point out here that the delta is approaching 1. And that's going to be an important thing as far as the portfolio is concerned. You want to get the leverage, and once you get to 1, you're extremely deep in the money. A couple of things happen. You get wider bid-ask spreads on the option contracts. They're not traded as heavily, and we're getting something that's going to act a lot like the stock. And here's one of the beautiful things, and I should emphasize this, about buying deep in the money options is as they go deeper in the money, you get more and more delta. You pick up more shares of stock. Like I was saying when we first started the presentation, I like to think of it in this strategy as stock price representation. So at this point in time, we started with an 80 delta, we're now got a 96 delta, or we could say we started with 80 shares and now we got 96 shares. But once you start getting deeper and deeper in the money, bid-ask spreads widen, I like to roll at that point in time. So that's what we did. So we got out of this position, brought in some capital, rang the cha-ching, and now we're looking to roll the next position, because before we know it, after the stock was at 681, after the earnings, they blew the market away, and we're getting closer and closer to when they're going to announce their split. Stock is at 900. Now, this is more common in what we're going to do. We're now at 296 days to expiration. So we're going to go back out, and in our concept, we would probably be, let's say we started with 6 months, went down to 3 months. Now we're going to roll back out to the same time period. So in this instance, we went out to 450 days. We sold 2 of the NVIDIA calls. We sold to close 2 of them and bought to open, once again, an 80 delta. taking some of the money off the table. We can allocate it to a different stock if we would like, but we still want to rebalance our portfolio so we're not too heavily weighted in the NVIDIA position. And on top of it, we don't want all the risk of being in this one option contract and having it such a huge chunk of our portfolio.